Hello everyone, my name's Andy. My channel is Finding Value. If you like this content, subscribe, click the up rate button. So I want to talk about understanding natural gas investment, the investment that we're doing, the strategy, and what that valuation is, because I think it's really important. Another thing I want to go over is everyone's walking around the world looking at the world with a certain paradigm. I'm going to say that they're looking at the world through these glasses. They're pretty ugly glasses, right? And they're like, hey, look, stocks and bonds, stocks and bonds, stocks and bonds, stocks and bonds. And they're looking through these glasses, and it's through the glasses, that lowering of interest rate from 1980 till today, and I'll show you in a slide or two, that it's declining the entire time. That's the trend. The overall trend was a decline. And they're looking at it through these glasses of the declining interest rate. And they're like, hey guys, stocks and bonds, stocks and bonds. Now, some of us, some other people, we took these glasses and we crunched them up, boom, chucked those to the side, right? We said, hey, look, there's these other glasses to see the world through. So we pick up these, and we're looking through these glasses now. You know, maybe they're cooler, maybe they're not, I don't know. So we're looking through these glasses at the entire world, and what we see is, hey, look, interest rates are going to go up, so we need to change our entire paradigm, our entire viewpoint. And that viewpoint is going to be higher interest rates. So we're valuing things differently looking through these glasses. We're saying, well, if that goes way higher, these are all super cheap. And those stocks and bonds don't look as good. So I'm going to go through this presentation. I just kind of want to cover that real quick. And we'll see if you like it. So this is a good one. So understanding natural gas investment. So this is the cycle, down, up, down, up, down, up, down. And I'm thinking and proposing that we're going to see it go back up, like this. You know, something like that or something like this. It's probably going to be big. So interest rates are probably going to increase in the future. And stocks and bonds don't like an increasing interest rate environment. They hate it. They absolutely hate it. So I want to describe to you the asymmetric bet with natural gas. And this is kind of what it looks like. Now, keep in mind, natural gas is a 1:16 ratio right now. So these numbers are off. This was at the total bottom. And this is what you need to understand. I talk a lot about ratio investing. And ratio investing tells us what is cheap. Natural gas, when we buy a producer of natural gas, it's a quadruple ratio bet. And I don't think people understand that. So I'm going to go through it. This is the Dow here. Gold is a 1-to-1 bet here. So it's going to go up 15 times if it goes to a 1-to-1. If Dow equals the gold, or gold equals the Dow, however you want to say it, this means that this would have to go up 15 times in purchasing power against the Dow. So the Dow lost purchasing power against gold. It's only going to be 1/15 the price of gold if it was a 1-to-1 relationship. Now, if gold goes higher, what this means is that gold is the inflation portion of it. This is inflation. Gold's going to go up because of inflation. This will go down because interest rates chase inflation. And they don't like interest rates going up. Oil is leveraged to gold. So if gold goes up against the Dow, oil is going to go up at a faster rate than the Dow. Then natural gas, now this is 1-to-15 right now. Natural gas is cheap to oil because it's going to go down by 2. If it's 16 is the number, and it'd go down 2 if it's 1-to-8 at a market top. So natural gas is leveraged to oil, and oil is leveraged to gold. Now the quadruple bet is if you get in a producer, and let's say the producer is a 5-6 times to 1 in natural gas with a small cap. That means you get 6 times the natural gas. Natural gas gets 2x on oil, and then oil will go 5x on gold, and then gold will do 15x on the Dow. So what this does, it'll reverse to this. And I was playing with the numbers. So these numbers, if you do the math, aren't going to calculate right because I was playing around with them so much. So 1 Dow could equal 1 gold, or maybe gold goes 2 times the price of the Dow, or it's 0.5 ounces. Oil goes 1-to-10 on average, and natural gas goes 1-to-8. Now, let's just say, let's divide this by 2 here, because that's not an actual. This is at the bottom when I did it. But natural gas times oil times gold. And you get something like 144x times increase of purchasing power against the Dow. Now the producers leverage that 6x. So if you bought at the bottom of natural gas when it was a 1-to-30 ratio some months ago, you could potentially have a 1,728 times return against the Dow by the end of all this. That's a pretty damn good return. You got to be looking at things through those different set of glasses. So we need to come up with an investment strategy, and my strategy I propose is find smart leveraged companies, market caps that are definitely under $1 billion, and better if they're under even just a few $100 million. We want to spread the risk amongst many small caps that have debt under control. Maybe a debt to earnings before interest and tax is less than 3.0. It's pretty good. That's what I would say is good. We don't want to get caught in the wrong one in terms of missing opportunities. So we want to spread that out and capture the highest gainers wherever we can. We gotta spread our money out, because these gains are so large that we got to capture some of those gains. And we don't know which one's going to gain the most per se. So we want to spread them out. We know they're all going to win. We just don't know how much they're going to win. We want to search for highly depressed market caps in relationship to assets. Find companies that are hedged to protect downside risk. Explorers, producers are what we want. Or we want companies that are acquiring assets and going to produce from those assets, because that's where all that value is created. Exploration creates value, and you can also get value by buying assets on the cheap. So the way that we protect ourselves, the way that we reduce risk is through technical analysis. This is going to protect us. It's important to know technical analysis. I know the fundamental guys, they say fundamental analysis, fundamental analysis. Well, how's your timing on your picks? Are you in your stock for 5 years and it's still riding lower? This is where the protection is. This is where the risk, the downside risk, gets minimized here. You got to combine fundamental analysis with technical analysis. The fundamental analysis is how well you can look at companies' balance sheets. It's how well you can value the assets, how well the timing is in the ratios. It's all of those things. So technical analysis is another skill. Look at the charts for downtrend breaks. We want to time the entry because we're the smartest money in the market. We want every last dollar we can get. We want to get a low dollar cost average in our companies. We want to look for momentum changes in the chart. And I show that in my market updates, what those momentum changes look like. Buy on a reversal contraction point. What that means is that you're going to see an up day and then it reverses back with real small little down days and comes to a point where the buyers equal the sellers. Then the bulls all line up at that door ready to run out when this stock breaks. And the short sellers have to cover too. So that's the lowest risk, highest reward point is right there. And I'll show that in my market updates and on charts. Execute the trades using a buy limit order as stocks in bottom of markets are illiquid and some of these companies are small and illiquid. So that's the strategy there, guys. That's the strategy. We need to find a bunch of companies. We need to spread that money out. Don't get too aggressive in one. You don't want to get caught in one that goes up 20x when we could have one that goes up 100x. I know that's weird. We got to spread it out, reduce our risk in case we didn't catch something in our fundamental analysis. So now you know what the natural gas bet is. It's a quadruple leveraged ratio bet. These are rare. And it's rare that they all line up like this on the cheap side. Doesn't happen often. And that's why sometimes I say that natural gas could be one of the best bets. I know uranium's a good bet, don't get me wrong. I'm not discounting uranium. I'm in uranium. I'm in natural gas. I've been acquiring assets in natural gas. I'm getting stocks. Now, you have to look at this as an investment. You're not looking at it as a trade. An investment and a trade are two different things. A trade is something very short-lived. An investment is an investment for 5 to 10 years. We are playing the long game here. We are getting in, cost averaging in, we're getting our shares, and then we're going to hold on. This is Finding Value. Hope you like the clip. If you like this, please subscribe. Thank you.